Think about the last car ad you saw. Did it tell you the full price? Probably not. It showed you a number like $599 a month. Sounds manageable, right? But then comes the fine print. 72 months, maybe even 84. That's 6 or 7 years of your future income. Promised to a machine that starts losing value the moment you leave the dealership. And somehow this feels completely normal. You finish school, get a job, pick a car, sign the loan. That's just how life works. Except, it wasn't always this way. A little over a century ago, many Americans thought borrowing money for a car was reckless. Banks hated the idea. Religious leaders warned against it, and respectable families didn't want their neighbors knowing they'd bought anything on credit. If you wanted a car, you paid cash. No monthly payments, no 7-year contract, no zero-down offer. So, how did America go from treating car debt like a personal failure to carrying more than $1 trillion of it? The answer isn't just about cars. It's about a battle between two powerful ideas. One man believed the secret was making cars cheaper. His rival discovered something far more powerful. You didn't have to lower the price if you could make people stop thinking about it. Go back to the year 1900. There are no traffic jams, no giant parking lots, no endless highways cutting through the country. American streets belong to horses. They move people, food, equipment, and almost everything else. But horses come with problems. They need food, they get sick, they leave waste everywhere. And when one dies in a crowded street, removing it isn't exactly easy. Then suddenly, a strange machine appears. It's loud, it shakes, it breaks down constantly, and it scares the horses. The automobile doesn't look like the future yet. It looks like an expensive toy for rich people. And expensive is putting it lightly. An early automobile could cost several times what an ordinary worker earned in an entire year. Imagine someone earning $50,000 today being asked to pay $250,000 for a basic car. That's how impossible it felt. Doctors, bankers, and wealthy businessmen could buy one. The average worker? Not a chance. Then Henry Ford arrived, and he had one obsession: build a car ordinary Americans could actually own. In 1908, Ford introduced the Model T. It wasn't fancy. That was the point. It was simple, durable, and easier to repair than many other cars. More importantly, it cost much less than most of its competition. Still, it wasn't exactly cheap. Buying one could require more than a year's wages, so Ford pushed harder. He simplified the design, standardized the parts, and in 1913, his factories adopted the moving assembly line. Instead of skilled workers building one car from beginning to end, the car moved past them. One worker performed one task, again and again and again. It sounds boring. It was also revolutionary. The time needed to build a Model T dropped dramatically. Production exploded, and as Ford's costs fell, so did the price. By the mid-1920s, a basic Model T could be purchased for less than $300. Ford had done something almost unimaginable. He'd turned the automobile from a rich man's toy into something a farmer, teacher, or factory worker could dream about owning. But there was a catch. Ford expected cash, all of it, up front. So families saved, not for weeks, for years. A few dollars disappeared from every paycheck. Money went into envelopes, bank accounts, coffee tins, or hiding places inside the house. Some families sold animals or farm equipment. Others borrowed from relatives. A few neighbors might even combine their money and share one vehicle. Buying a car wasn't an afternoon decision. It was a family mission. First, you earned the money. Then, you got the car. And people believed that was the responsible way to live. But there was a problem hiding inside Ford's success. His factories could now build cars faster than American families could save enough money to buy them. Ford had accelerated production, but the customer's wallet was still moving at human speed. Something had to change. Now, buying products in installments wasn't completely new. Americans had already used payment plans for sewing machines, furniture, pianos, and farm equipment. But cars were different. A piano could sit inside one house for decades. A car could crash tomorrow. It could be damaged, stolen, or driven hundreds of miles away. And it lost value quickly. If someone stopped paying for a sewing machine, the seller could take it back and resell it. But if someone stopped paying for a car, the lender might recover a broken machine worth far less than the unpaid debt. To traditional banks, that looked like a terrible deal. There was also a moral issue. Debt was often connected with weakness and poor discipline. If you couldn't pay cash, people thought you shouldn't be buying it. Simple. But car dealers faced a different reality. They had vehicles sitting on their lots and customers standing in front of them saying, "I want it. I just don't have all the money today." Some dealers quietly began making their own arrangements. Pay part now, take the car, pay the rest over time. If you miss too many payments, the dealer takes it back. These early deals were small and informal, but they proved something important. People weren't refusing to buy cars because they didn't want them. They were refusing because the price arrived all at once. Then one company realized that splitting the price could change everything. In 1919, General Motors created GMAC, the General Motors Acceptance Corporation. It sounds boring. It wasn't. This financial company would become one of GM's greatest weapons. At first, it helped dealers finance the cars sitting in their inventory. Then it helped customers finance the cars they wanted to buy. Suddenly, a family didn't need the full price. It needed a down payment and a promise. Think about the psychological difference. Pay $600 today feels painful, but pay $200 now and smaller amounts every month feels possible. The car didn't become cheaper. The price was simply broken into pieces, and small pieces don't feel as dangerous. That was the breakthrough. Ford was asking, how can we reduce the price? General Motors was asking, how can we reduce the pain of paying it? Those are not the same question. And GM had another advantage: choice. Ford believed the average person needed a simple, dependable car. General Motors understood that people didn't just want transportation, they wanted progress. Under Alfred Sloan, GM created a ladder. You might begin with a Chevrolet. Later, after getting a raise, you could move up to another GM brand. Eventually, if life went really well, you might arrive in a Cadillac. Each new car became proof that you were winning. Your home might be hidden on a quiet street. Your bank account was private. But your car, everyone could see it. At work, at church, in front of your neighbor's house. Ford was selling transportation. GM was selling status. And financing allowed people to buy that status before they had saved the full amount. Henry Ford hated this idea. He believed debt encouraged impatience and irresponsible spending. So, he offered an alternative. Customers could make small weekly deposits through Ford's savings plan, but they wouldn't receive the car immediately. They had to wait until they'd saved the full price. Responsible? Absolutely. Exciting? Not even close. Imagine two dealerships. At the first, you hand over part of your money and drive home today. At the second, you hand over part of your money and walk home. Then you return next week, hand over more money, and walk home again. Which dealership are you choosing? Exactly. Ford's system tried to defeat human desire with patience. GM's system used human desire as fuel, and Ford began losing. Customers wanted enclosed cabins, new colors, smoother engines, and more comfortable seats. They didn't always want the cheapest possible machine. They wanted the car that made them feel successful. By the late 1920s, even Ford had accepted the reality and entered automobile financing. The man who resisted car loans had been forced to join the system. Credit had won. But here's what most people miss. Financing didn't just change how cars were purchased, it changed the cars themselves. If people paid cash and kept a car until it stopped working, manufacturers had to wait years for the next sale. But with financing and trade-ins, the cycle could move faster. Buy the car, make payments, trade it in, finance another. Then manufacturers discovered something else. If next year's car looked different, your current car suddenly felt older. Change the grille, add more chrome, redesign the body, introduce a new feature. Nothing had to be wrong with your vehicle. It only had to look like yesterday. Financing made replacement possible. Styling made replacement desirable. Together, they created something powerful: permanent dissatisfaction. And that's the real reveal. The most important invention wasn't the car loan itself. It was a new definition of affordability. Affordability once meant, I have enough money to buy this. Now, it often means, I can survive the monthly payment. One definition measures the total cost. The other measures how much pain you can handle every month. Today, the question at the dealership usually isn't, how much do you want to spend? It's, what monthly payment are you comfortable with? Listen carefully, because that question moves your attention away from the price, the interest, and the number of years. A $50,000 vehicle feels enormous, but one monthly payment? That feels temporary. Repeat that temporary payment 70 or 80 times though, and it becomes a piece of your life. Your future paychecks, your future choices. maybe even your future freedom. Now, credit isn't always bad. A reliable car can help someone reach a better job, take children to school, or live somewhere without public transportation. Sometimes, a loan is a bridge, but every bridge has a toll. Ford changed America by making cars cheaper to build. General Motors changed America by making cars easier to buy. And that second idea may have been even more powerful, because Ford placed the automobile within reach. Financing taught Americans to reach for it before the money existed. So the next time someone says, "It's only $699 a month," pause for a second. Ask for the full price. Ask about the interest. Ask how many months of your life are hiding inside that small, friendly number. Because you're not only deciding what you can drive today, you're making a deal with the person you'll be 6 or 7 years from now. That person isn't sitting at the dealership. They can't read the contract. They can't object. But eventually, they'll have to pay for the decision. And maybe the real question isn't, "Can I afford this payment?" Maybe it's, "When the future finally arrives, will I still believe this car was worth it?"